Good morning, my name is David Blackman, editor of Pensions Insight, and I'm here this morning to interview Mark Wood, Chief Executive of JLT Employee Benefits. Good morning, Mark.
Good morning.
You were quite critical of Steve Webb's proposals around switchable annuities, which appeared at the beginning of last month, particularly in the light of the FCA's recent report into this market. What do you see as the way forward for annuities?
Well, first of all, I just need to clarify my response to the Minister's observations on annuities. I think the idea of switching annuities is fraught with difficulty because as the providers of annuities need to calculate the amounts that they're going to be able to pay, they need to fix long-term investment contracts against the payments that they're going to make to individuals. And the consequence of that really is that if we introduced switching into the market, it would make the value of the product to the individual far less than the benefit that they potentially derive. And of course, none of us can know what that benefit will be because none of us know what the financial markets will be for the future. So that was really my concern. Yeah. That's not to say that the notion of allowing people to move from one product to another under some structure is not a good one. I think the fundamental issue that people have with annuities is once you've signed, that's it for life. And of course, that's a very bold decision. So I suspect we need to look at the structure of how an individual contracts with the insurance company. The notion of just allowing somebody to switch, as you would with your motor insurance, doesn't work because of the investment strategy that sits under the product. So the solution, getting to your question, the solution I think is that we need a much more clear definition of what an annuity is relative to somebody's pension saving. And of course the recent FCA report has really pointed this out to people. And in my view, it ought to be impossible for an insurance company to provide a quotation on their own annuity product without also giving the best rate in the market, so that you just have a simple comparison between the company that you've been saving with and what they'll convert your savings into in terms of an income and the best rate that you can get on the market at that point.
Can you see a way in which this might work, i.e. the fixed term annuities?
Well, in the States, the concept of a fixed-term annuity has been introduced, which has some benefits. Of course, you know, it's always difficult to translate financial products from different markets, and the tax regimes and the legal structures that exist mean that it's not always possible to just simply transfer an idea. But I think if people were able to exchange an amount of capital for an amount of revenue for a 5-year period or a 10-year period or a 15-year period, that might be a more satisfactory solution. The problem with the switching is that you can do it at any point, and therefore you can play the market and catch the investment strategy out because something's changed in the market. Whereas being able to simply secure an income for a period of time makes it rather similar to an equity release product in a sense. You fix a yield on the capital, exchange the capital for the revenue, and then redeem the capital.
Do we have any evidence of how it might work in terms of value for money for the saver?
Well, again, I think the problem is that one's looking forward to investment markets for the future. The big unknown for people planning for retirement at the moment is the level of inflation. And of course, because the consensus is that inflation is low and will remain low, whereas the reality for most of us is that the things that we actually spend our money on are going up in price, and therefore we're experiencing a level of inflation which is not tracked by either CPI or RPI. It's CPI and RPI are counting inflation on some items of expenditure, but not typically what people spend their weekly wages on. It's difficult to think of a financial product that enables you to immunize yourself against the rising cost of the things you actually need to buy. And so the idea of being able to take a contract for 5 years and then recalibrate that contract becomes quite attractive because we've got this sort of slightly artificial environment in terms of the cost of living and measuring the cost of living and translating that into a financial services product.
This would permit people to make a decision based on their current circumstances.
Correct.
JLT's been expressed a lot of interest in enhanced annuities. If more people take out enhanced annuities, is there not a risk that those unable to take advantage of this will see dramatically reduced annual payments?
Yes, the parallel I draw here is with motor insurance when Direct Line was launched. So when Direct Line came into the motor insurance market, they introduced the concept of underwriting a motor insurance risk. Previously, the rates were very broad tables and they were rarely changed. And that was the innovation that was brought into the market. And I think enhanced annuities will turn out to be an early version of an underwritten annuity market. So rather than just take a broad estimate of what somebody's life expectancy is going to be and quote them a single life or a dual life or an index linked or a level payment contract. It will be an underwritten contract that looks much more closely at an individual circumstances. And I think we'll see the market evolve to a level where individuals answer a progressive number of questions depending on their own characteristics. So, for example, if you're completely clear in terms of health, you'll answer 4 or 5 questions and a quotation will be given. But if one of the answers to those questions triggers the fact that you may benefit from answering a series of questions about your smoking history or your blood pressure or some other element of your personal characteristics, then the underwriting will give you a more precise quote. And I think that's the way in which the market will operate, and therefore this debate about how can you have more than half the market being enhanced disappears, because the whole market becomes underwritten. I think quite quickly we're moving to a point where we'll have an underwritten annuity market with prices reflecting individuals' life expectancy.
You've talked about the idea of a spot price for annuities. Can you explain the benefits of publishing such a spot price, and can you explain how this would work?
Well, as a big annuity broker, the big problem we have is that we get a quotation for a client, and we then go back to the insurer to confirm the quotation, and the quotation often changes. And so the notion of a spot rate is that just as you would buy currency, and you know that the quote that you're getting is a quote you can trade at, and it wouldn't be bettered by going to the counterparty that you're trading with and negotiating, as it were. So we should see the annuity market work in that way, so that an insurer puts a price up, which is the price that they'll trade at, not a price which is an indication designed to enter into a conversation to then establish a quote. We find typically with larger annuity packs that we'll go around 2 or 3 times before we're confident we've got the right rate. That makes the expense of an individual surveying the market really quite demanding. I mean, it can be quite a serious reduction in yield in terms of the fee that's paid to the broker to achieve the best price. So I think simplifying all of that process and having rates that are put into a central repository so that people can access those rates and know that they can trade on them for a range of values. I mean, clearly they're above a level, there'll still be an individual market where the appetite of an individual insurer will become critical to the rate that's offered, but within a range which will cover the vast majority of people, a spot price would seem to me to be quite a realistic aspiration.
Turning to de-risking, obviously a big area that you have massive experience in. What do you believe are the prospects for the de-risking market for the rest of this year, and are we likely to see a record level of bulk annuity transactions as many people are predicting?
Yeah, well, I think de-risking broadly breaks into 3 components. So there's the de-risking that companies undertake by making offers to individual members, and so we're seeing an increasing number of pension increase exchanges or enhanced transfer value exercises taking place. Secondly, people are buying annuities into their pension schemes so that they insure an element of their liabilities, and then thirdly buyouts. And the combination of buoyant equity markets and quantitative easing coming off has created an extraordinarily competitive market. The last quarter of last year, I think, was probably the busiest 12 weeks that we've seen in the bulk market ever. If I think I'm quoting the records correctly, if I say that up to the 30th of September last year, the market had already exceeded the previous year, and in the full year the market was larger than the whole of the previous 4 years. So it's a very significant step up in volume. Some are talking about a pipeline of £15 billion worth of transactions for 2014. I think our estimates are more like 10 to 12, but even that would be pretty much double what we've seen this year. So the bulk market, I think, is likely to develop very rapidly. We're aware of 3 or 4 new insurers who are planning to come into the market, and that will make the market more competitive. So it's a great time for pensions managers and finance directors to be examining the chances of moving that liability off balance sheet in its entirety. Yeah. There are many companies, and particularly the very large schemes, who are using buy-ins to slowly manage down their longevity risk and their investment risk. And again, I think the market will be boosted by the fact that there'll be several 200, 300, 400 million pound transactions where an insurer is writing a block of business coming in. And the way in which the market is being priced is changing as well, because I think increasingly we're seeing the sponsoring company and an insurer agree a price at which they'll trade, and then they wait for the market to be able to deliver that price, and then they trade. Whereas previously we've seen people make the decision to buy out, and then the length of time that it's taken to secure quotations has dictated when the transaction has taken place, which is not always optimal as far as the market is concerned. So the way in which the transactions are taking place is changing as well. And then on the enhanced transfer value and pension increase exchange market, there are a wave of exercises taking place at the moment, with tens of thousands of employees being offered individual terms. And the way that I think about this is that people are individually buying out from the pension scheme for their own motivations, and in our view something between 10 and 15% of a pension scheme population might, on the basis of their characteristics and their status, prefer a buyout on an individual basis from a defined benefit pension scheme, so that they can manage their own investments in preparing for retirement, than leaving it in the defined benefit scheme and knowing precisely what their benefits will be, but those benefits being set by relation to the average of the population of the scheme rather than their particular requirements.
Do you think there's a chance that we'll see an even bigger deal than the EMI transaction this year?
Yes, the EMI at 1.5 billion with Pension Insurance Corporation was the biggest to date, of course, and I think we're seeing speculation that there'll be a transaction of £3 or £4 billion this year. So that clearly nudges the total.
A single transaction?
A single transaction, yes, and we've got at least one insurer who has expressed a firm appetite to do a trade at that volume. Now, the conventional wisdom, of course, has been that gives an insurer too much concentration risk, one block of business of that size. But of course, with the annuity market accelerating at the rate of perhaps 12% compound per annum, the individual annuity books of the largest annuity writers are very, very substantial and growing. And therefore a single trade of this size becomes practical. The other thing about a trade of that size, of course, is by definition the population of people in that trade is quite large, so you do benefit from actuarial averaging.
Do you see much evidence that capacity is increasing in the reinsurance market?
Yes, the Hanover Re, of course, have dominated the market as it's developed, and as is the case with any market, when one entity finds it possible to make a success in that market, it attracts competition in, and I think we're in that phase now where both on primary insurers and reinsurers are examining the market and establishing whether there is merit in coming in. Do
you believe the government was right or wrong not to press ahead this year with its proposed pension charges cap?
It's a really difficult thing, this, isn't it? The charging cap, in a sense, I think, is shooting at the wrong target. The issue is that people need to be able to make sure that they get good returns over a period of time. And if those good returns are net of a high charge, but they're nonetheless outstanding returns, then clearly the individual is benefiting. If the returns are appalling, but the charge is very low, the individual's losing out. So I think this is an area that's fraught with difficulty. I think wisdom was shown in withdrawing the implementation of the cap for one simple reason, and that was that there was no consensus as to what the right level was or how it would be implemented. And the implementation timetable on top of all of the work that's being done around aligning GPPs with auto-enrolment would probably have been too great a strain on the industry as a whole, particularly the insurers. I think when we reflect on auto-enrolment, one of the surprises I think that everybody has experienced in the auto-enrolment is just how many idiosyncrasies there are in the way in which people deal with their payrolls and their pension structures within companies. And layering auto-enrolment systems onto established payrolls with established pension conventions has been hugely complicated. We've assessed just over 1 million employees and have just over 500,000 employees using BenPal with auto-enrolment across a vast range of different companies. And every one of those companies has some unique and different way of dealing with some element of their pensions, which requires us to adjust the system to be able to accommodate that. It is immensely complicated. So I think implementing the charging cap at this particular point in time might just have been the straw that broke the camel's back.
How can we build up confidence in long-term saving without a pension charges cap?
Well, confidence, I think, will come. The new annuity market review, I think, is very important because, you know, when you get to the point of wanting to draw on the savings that you've accumulated during your lifetime of working, you want to be confident you're making the right decision. And the evidence is absolutely irrefutable and is well expressed in the FCA report. By simply flipping from the savings contract that you've had through to that company's annuity, you do not get best value. Or if you do get best value, it's by chance. It's more likely that you'll get best value by surveying the market. So that's a very important element, and I think this review that we're about to embark upon needs to be done relatively swiftly, and it needs to be quite conclusive. And in my view, it probably will involve some legislation. Because it will become, I think it's necessary to impose an obligation to not simply offer the price of flipping from one big brand savings contract into the same big brand's annuity. I think the consumer almost needs to be forced to look at the market. It's very curious that with motor insurance we are all instinctively aware that we go online and we put our bits and pieces in and we get a quotation, and yet with a much bigger transaction, buying an annuity, because it's something to do with pensions which are complicated, somehow we resist that notion, and we need to get to the point where we look at the market in the same way. So that will build confidence, I think, that report.
As people get better engaged with pensions, does that mean they'll be in a better position to make that decision when they reach 65?
Yes, although getting to 65, I think, will be less and less important. It will be 67 or 69 or 70 or 75 or 82, as my mother was telling me the other day. No, I think we've got to accept that this glorious period that we live in, where medical advances have meant that we live longer, healthier, does have an impact on the way in which we work. And it's very, very interesting looking at the unemployment statistics that have just come out. The number of, I think it's 18% of the workforce work part-time. A good proportion of those are over 60, and the vast majority of those people want to work more time. So I think we will see a greater shift to non-standard hours working contracts, probably lower than the typical sort of 35-hour contract, and people perpetuating their working practices 60, 65, 70, 75. And that means that the pension is the bit at the end. And I think we've sort of lost the idea that a pension is how you finance the non-working final phase of life. It's become a sort of equivalent of growing up and being a student or starting your work, the bulk of your working career, and then another third. You know, we talk about the third age, don't we? I'm not sure that's a concept that stands financial scrutiny.
What's your assessment of the auto-enrolment rollout so far? Are you still concerned about contribution rates?
So far so good, and too early to judge. I think the difficulty is because this tiny little skim comes out of people's pay packets, nobody really notices it. And certainly putting 1% of your remuneration into contention with current consumption is not really a debate. Everybody knows they should save more. So if I'm forced to save 1%, that's fine. When we get to 5, 6, 7, 8%, or the 18% that is required on average across a career to make a contribution equivalent to providing a defined benefit pension plan, then the deferment of consumption becomes a real issue. And I think we're only going to know really whether compulsion is working when we get to the levels of contribution that are already in existence in Australia at the sort of 9, 10, 11% level. It's very interesting in Australia. When compulsion was introduced in the early 90s, if I remember correctly, the savings rate overall for the population was 12%, and the compulsion rate was set at 9%. When a survey was done 3 years later of how much people were saving, they discovered that the population as a whole was saving 9%. So people had inferred from the fact that the government had set 9% as a saving level that that's all they should save, even though the average previously was 12%. So it was of those saving was 12%. So the danger is that we get people inferring that 1%, 2%, 3% is the right level of saving to provide for a pension. Of course, it will never be. It has to be very materially higher than that. So I just simply think it's a great start. I think we've seen a lot of very good examples of outstanding communication to people. I think the general awareness of the need to save has gone up, so it's achieved all of its short-term goals, but we'll only really know if it's working from a fiscal point of view in a few years' time, when we get the contribution rates up to a level where they're making a serious impact on people's ability to finance retirement.
Finally, were you thinking about your vodka-swilling daughter, who you referenced, of course, in your interview with Pensions Insight this time last year, when you commissioned your recent research about the link about drinking and savings rates?
Well, it's interesting. I was with my vodka-swilling daughter the other day, and she's still swilling vodka, I'm happy to report. That survey that we did, or that piece of analysis that we did, was really trying to capture a way of conveying to people the power of compound interest, and we were trying to come up with a way in which you could understand very intuitively, if I don't have a pint of beer today, how many pints of beer can I afford in retirement? And I think the notion of setting aside a bit of money now in order to enjoy something you enjoy today, tomorrow, is really at the heart of why people pension plan. So that was the whole concept of it. And this, this notion that compound interest is the most powerful force in nature, the most difficult thing to conceive arithmetically. And yet if you don't track it, it runs away with you. If you can flip that to the benefit of saying, so if I save on the same basis, my savings escalate, then that's a big part of getting the message of the importance of saving across.
Mark, thank you very much.